Good morning, John. It's good to see you. We're recording this view on Thursday, the 9th of October. And John, it was good to wake up to some new all-time highs on Wall Street. I think the S&P 500 just completed its 33rd new all-time high for the year. And I'm starting to read in all the newspapers and the various talking heads about whether there's a bubble or not. And perhaps there is, perhaps there isn't. Maybe we can chat about that. But more importantly, how should investors behave if indeed there is a bubble? So what is your impression? Is there a bubble in AI stocks, do you think?
Well, it's going to be more obvious looking back, isn't it? You can always identify a bubble after it's exploded. As it expands, and we're talking about expansion of price measured by ratios, so we're talking about higher price earnings ratios, and then you don't want to get too caught in looking backwards. You want to say, well, is the market correct about its forward estimate of earnings, and therefore your PE ratio is fair? And then the other one is the cash flow yield. Whether these businesses are going to generate cash flow to justify the share price, and compare that to, say, the cash flow coming off a bond, which is your risk-free rate of return. The historical rule of thumb is, the bond yield or the inflation rate plus the PE is around about 20, and that's fair value. Well, when you've got PEs on the whole American market, but obviously weighted heavily to NASDAQ in the high 20s, then historically you've got overvaluation. And when you add the bond yield or the inflation rate, you're in excess of 30. So you've got an excess there, there's no doubt about it. That can only be tempered by earnings growth.
Yep.
And as you just said in your question, is AI hype? Well, the technology actually exists. It is working across the world. It's operating across the world. Is it going to turn into extraordinary profits for those companies employing a lot of capital? Time will tell. And that's the dilemma we've got. So the bubble will be determined by the earnings that come out of the massive capital investment in AI. But we'll have to go through time and see, Paul. That's the problem.
John, we started off the year being a bit nervous about recession in the US, and yet that hasn't occurred. First quarter earnings out of corporate America was better than expected. Second quarter, significantly better than expected. We're about to begin the third quarter of earnings, and analysts are upgrading their expectations. So even though the multiple is high, corporate America is doing incredibly well. Profit margins are high, and AI seems to be one area where there is a lot of froth and bubble. But the earnings for the Mag 7 are kind of coming through even better than expectations. So I guess it's a quandary. What should investors do? Do they stay in this?
Yeah, well, we've talked about this, Paul, off camera about bubbles, but I'll just answer the first point. We've got to look at earnings, weighted earnings. So you're right, we're getting substantial earnings upgrades for the index, but it's heavily weighted to a few stocks. Now, listening to a podcast this morning, there are reasonably significant cost of building increases coming through the housing market of America. So the cost of building a new home is going up quite substantially, and you can understand why, with the tariffs and the replacement of imported goods. But that's an issue. Now, so that the mainstream is being affected by cost of living increases more so than, say, the wealthy of America or the people who actually live in a home already and own it. Similarly, in the stock market, there's a few large companies which are doing very well, and they're spending a lot of capital on AI and development, and that generates income for other companies, downstream effects. So that, I think, is pushing the American economy and pushing the earnings of a significant, well, not significant, a large company section of the American stock market. Okay. Now back to your bubble question. Off camera we were talking about what do you do when you see a bubble. And we had an investment meeting this morning, and I'll be talking about this as I go around Australia because I think it's a very topical point. Bubbles are reappearing, and the equity market in America is arguably in bubble territory. It doesn't mean it's going to end, but it's important for investors to acknowledge that it is a bubble. And when a bubble is being created, you've got a choice. Do you watch it and do nothing and get frustrated by what you could have done, or do you get involved? Now, obviously getting involved means investing, and as that bubble and as PE ratios expand, you're getting higher risk returns. And you should get higher returns for the risk you're taking, but acknowledging that it is a bubble means that when you're investing, you're probably not set and forget you're investing and then looking to extricate yourself slowly as prices expand, unjustified by the cash flows coming off those assets, okay? So I guess it's a job of us to talk to clients about, realistic returns, what we're trying to achieve over a time frame. Excessive returns in the short term should lead an investor to say, is it time to take some money off the table and reallocate across asset classes? Go from high risk to more high yield, and things like that. So it's an asset allocation decision. So de-weighting one asset class, which is excessive, and re-weighting to another asset class, which is giving you relative value based on a risk adjustment.
Yeah. And John, it's interesting to reflect on a personal level. I mean, both of us have been in markets close to 40 years. I started on the Johannesburg Stock Exchange in 1986, and I remember 1987, the market crashed very, very well. And then coming to Australia, I remember the crash in 94, the crash in 2000. And bubbles are really interesting and, as you say, very, very hard to predict, except in hindsight. At the moment, the Australian market doesn't feel like it's bubbly, although there are areas of overvaluation, like we've spoken about, the banks being on very, very unusually high multiples. I want to talk a little bit about commodities, because there we seem to have a bit of a bifurcation. We've got gold and platinum and silver. Silver's not an all-time high, but gold certainly is over $4,000 an ounce. And at the same time, we've got oil at quite low levels, which is exactly what Donald Trump wanted. So it's keeping inflation down, the gas price at the pump down for American consumers. Do you see the gold price being at an all-time high as a reflection of a lack of confidence, perhaps, in central banks and fiscal policy across the developed markets?
Absolutely. I mean, at the turn of the century, every Western government was told they had a demographic challenge in terms of ageing population and lower birth rates, a social security issue developing inside budgets. The 2000 crash and then followed by the 2008 GFC meant that Western governments didn't address their fiscal problems. Australia's come out of it relatively well. Our debt is at relatively low levels. I'm talking Commonwealth debt, not state, which is a whole different game there, state debt. And I think the flight to gold and even Bitcoin is an expression by a part of the market and capital providers that they don't have confidence in the leadership of the Western world and the policy settings of the Western world, and the emergence of Trump and his unsettling or driving a short-term policy change. I don't know if he has a long-term vision, but he's challenging the lack of initiative right across the Western world. His policies challenge his counterparts in North America and certainly across Europe. Where's their policies? They haven't had a policy for 25 years dealing with their demographic problem, and now they've got, as you know, a NATO problem. They've got an immigration problem. They've got a wealth divide problem. So I think gold is a reflection, as is Bitcoin, a reflection of discontent by capital providers in the planning going on in the Western world. And the risk that government debt is financed through printing of money. Now that leads you to other sources or relatives to currency. That's what's happening. Just listening to the ABC this morning, and I think the Reserve Bank put out its profit for last year, and I don't want to misquote it, but it seemed that virtually all the profit, bar more than 100% of the profit, was from gold revaluation. So a mark to market of gold, and it's not as if they're flush with gold. I think the valuation was about $12 billion or something. So in an economy of $2.8 trillion, having a $12 billion in gold doesn't seem like a lot. So Australia, as a gold producer, again, it's reflective right across commodities and energy. Australia's a great producer of metals and commodities, but we don't utilise it to our benefit.
Well, that brings up a topical point about what's happening in Mount Isa, where the smelter there, which was owned by Glencore, was under threat of being closed down. I think government's putting up something like $600 million. Why can't Australia develop the value adds that come with our abundant resources, John? What's wrong?
Look, I will show a chart in my presentations in coming weeks about where earnings are generated across the world, across markets, and by inside countries, so a country comparison. And the highest returning companies in terms of margin, gross margins, operating margins, exist in the Middle East, Saudi Arabia in particular. So their companies are very profitable. Why are they profitable? Because their cost of energy is so low. And Australia has lost a big opportunity by maintaining low cost of energy as it's gone on this great debate about decarbonising. Now we're realising, I heard the industry minister this morning, it's now a statement of government that gas is a transitional energy source, as if it's the lights that come on. It's always been a transitional source of energy. They just haven't cared about it and created policy around it. So we export energy and don't have enough for ourselves, and we're paying ridiculously high costs, and it's going through the manufacturing sector. We've debased our manufacturers. BlueScope's CEO, to his credits, come clean and had a crack at it. Glencore, who's a multinational company, doesn't need to really be in Mount Isa, has virtually said we're going to close down our smelter unless we get government assistance because we can't make it work at the cost of energy. And because they're a multinational company, they have lots of choices. Okay. Now, you made the point about how old we are earlier, Paul, and I guess the viewers can make their own assessment based on the colour or lack of hair we have. But you and I both remember when Mount Isa Mines was the biggest company in Australia.
Yep.
Bigger than BHP at one stage.
Yeah.
Hard for people to realise that. That is indicative of what a large resource is underneath Mount Isa. What a large resource. It was the largest company. Now it's being sold to foreign ownership. And now that those foreign capital owners are saying to the government, well, we're going to close down unless we get your support. And the Australian government is coming back. I think the figure was $600 million over 3 or 4 years. And you've got an industry minister in chaos trying to explain what he's doing, and he's doing it also in South Australia, he's doing it in Tasmania, bailing out smelters, because Australia has not had that long-term policy planning. I mentioned earlier about the whole Western world at the turn of the century. That was a demographic challenge. Australia, we had a bit of a demographic challenge, but we've made it worse by making the cost of living so horrendous, and energy is a big part of that, as is the cost of housing, but we don't want to go back there again. We have cruelled the opportunity. Now we need to switch aggressively to support Australian industry and plan for the opportunity which exists in front of our eyes.
Yeah, John.
You can't make money out of just being a service economy, which is where we're driving to.
Yeah. the lack of strategic planning for our energy industries, an ongoing theme of all our discussions. We've been talking about it for years. John, during the week, the Central Bank of New Zealand cut interest rates not by 25 basis points, but by 50 basis points, down from 2.5 down to 2.0. I was in New Zealand a couple of weeks ago to watch the Springboks beat the All Blacks, which I enjoyed.
Yeah, there you go. There you go. Go
on. But John, New Zealand's in quite a serious recession. Does what the New Zealand central bank's cut influence Australia, do you think, at all? Or does it make a cut here in November any more likely?
Well, New Zealand's lost its way. I've been on the record saying I complimented the quality of leadership, both in the central bank and the government. They've had succession up until about 5 or 6 years ago of high quality people, and they seem to have lost their way. I don't want to go into it, but they seem to have lost their way of some parts of leadership. New Zealand aggressively increased interest rates, followed America and even jumped ahead of America's cash rates. Australia didn't do that. And I remember saying at the time, well, that's a strange way of addressing what really was a property market bubble, a residential property market bubble in New Zealand, cost of living crisis. And then they, as an energy importer, got hammered after Ukraine war. They went way too aggressively and didn't acknowledge that there was a significant part of inflation which was transitory and not embedded. And so they overshot on interest rates and created a recession. Pretty dumb policy. Now, the aggressive cutting of interest rates, is that going to do anything to pull them out of it? Time will tell, but you know, they live on exports and tourism. You know, exports of dairy in particular, and tourism. Now they devalued their currency, and I was on a board meeting this week, and we have New Zealand operations, and you know, it's worth acknowledging the New Zealand dollar has weakened fairly aggressively against the Australian dollar in the last 6 months. Does that attract investing? Well, for our company, it will. We're going to do some investing in New Zealand. So a weaker New Zealand dollar, lower cost of debt will stimulate some capital flows if they can get broader economic activity through the government sector stimulating the economy. I've always thought the Reserve Bank of New Zealand was doing a good job when it was first to try and stop property market speculation with foreign ownership, something Australia should have done. But the interest rate policy has been chaotic over there, and they're wearing the consequences. So the learn is don't panic as a Reserve Bank. And I thought our Reserve Bank was pretty average, but I think New Zealand's Reserve Bank's probably got the list of the poor performers, I think.
Just on the topic of house prices, the Cotality results was it September, I think, came out, showing that house prices across all the capital cities going up again, starting to get a little bit aggressively bid for at auction clearance rates. So we're going to see another move in house prices here in Australia. And there again, there's the 5% deposit that they're allowing first home buyers. We've spoken about this. Is this a wrong-headed strategy yet again?
We talked about this last week with the MD of Clime in the View. My comment then still stays. We're getting very close to the end of the jokers which the government can play to stimulate price increases and almost justify that that's good news for Australia and good economic management. It's appalling economic management. We want to make housing affordable, not unaffordable. That should be the criteria of success. But they're creating more speculation, more leverage into the property market. Yes, supply is an issue. We've got an immigration debate going on, and you know, let the politicians work that one out. But that's obviously come into play. But I foresee a situation where there will be a swathe of mortgages which have very limited equity support for the lender, which have to be pushed into a bad Bank of Australia. and that'll be the government sector, and I've got a view on that, which again I'll talk about when I go around Australia in the next few weeks, because I have got an interesting take on that, where I think it's going to end up in 5 years' time.
And because we've done away with the first home buyers needing to take mortgage insurance, the taxpayers will be left holding the bag, won't they?
Yeah, but there is a fund available for Australia to take that on, which I'll talk about in the coming weeks. But
Okay.
a bit of lateral thinking.
Teaser there. I think we're coming on.
Come and see the presentation.
Come and see the presentation. Well, we've done our 20 minutes, John. Lots to talk about as always. I encourage you to attend John's presentations. It'll open your mind and help you think through your appropriate investment strategy. John, thank you so much. Always good to talk to you, and we'll see you next week.
You will.